Today, folks, we are on the pivotal edge, dare I say the eye of the hurricane when it comes to this all-time high market. And if we're going to keep printing those tendies, or are we going to head into a correctional period as earnings dictate that this week? And while we're waiting for those major tech companies to post, for those dividend lovers out there, we have a lot of dividend stocks to talk about today because, as many of you know, SCHD is my largest passively weighted ETF for dividend income. And for those of you that don't know, SCHD's been on a tear recently. Unlike the S&P and tech companies, it took a little bit of lagging leading up to the interest rate cuts for this stock to start to rally. And we're still in the midst of interest rate cuts. And I told you really want to pay attention to the components. It's going to tell us whether we're in a soft landing. Is this ETF undervalued? Could it continue to rally? Well, we can only tell by breaking down the earnings of the stocks that we have here, right? And the earnings that we got today that I think are the most fascinating for you sinners out there that like to pump up the tobacco sector, because I know some of you are sinning, because they can't be paying that yield unless someone's paying it. We're going to talk about Philip Morris, the geopolitical events, war in one of the most unstable geopolitical environments. We have a stock that is unbelievably stable, taking advantage. Morally, that is left up to you, whether that could be a sin stock or not with Lockheed. But we're going to talk about 3M. We're going to talk about General Motors after cutting the electric vehicle race to focus on margin and operating income expansion. Man, this is going to be a fun video. So if you are on a path to financial independence, if you love capital gains, dividends, and so much more in between, go hit that subscribe button. Join me on that journey and slap a like for these kind of deep dive oriented videos. As we kick it off with Philip Morris, the tobacco giant, this sin stock has been on a historic run unlike anything it's seen in the decade prior. I mean, zoom out on this sucker and we've had nothing for 12 years. And people are buying this for the dividend that is no longer as appealing because Philip Morris never really grows their dividend that much. It's not like a huge explosive dividend grower, but it was a stable income producer, which is why people owned it. But now at a 4% yield, it might be getting a little bit valued here. As we take a look today, it is up another 9%. Clearly, a lot of you are joining this sin sector. A lot of you out there be puffing away. You're almost making this a $200 billion market cap company. A market cap it's never really seen. I mean, it came close probably in 2017, but we are breaking those new highs, baby, with no surprise. Cigarette shipment volume is up 1.3% over the quarter, right? Which is crazy over the year over year. Heated tobacco units are up 8.9% and 13.9% on the 9-month. You know how crazy that is? This company is actually seeing major double-digit growth in things like nicotine pouches, which I'm sure you're seeing are becoming hugely popular amongst the youth. That seems to be the new way of doing things. It seems to constantly be floating between vapes and nicotine pouches, but they have double-digit growth in other oral products too, right? Like this seems to be the new segment. This company, Philip Morris, unlike, MO, I'm not the biggest fan of Altria because it's so fixated on the US, whereas British American owns almost 30% of the global markets. It's getting up there, 29.5. So if you go out to international, Philip Morris is a leader, and it all bakes into this almost double-digit revenue growth at 8.9%. Woo, baby. We're on a new tear here, which is no surprise when you look at the earnings growth finally coming back with a vengeance, really driving up that stock valuation, which again, is it overheated? Yeah, time will tell. That pun, I don't know how hard it holds. As we take a look at the second giant here, but in the opposite of sin sectors, we're talking about another stable oriented. You paying your phone bill every month? Well, you can collect some revenue on it because Verizon's still paying a whopping 6.47%. Was up it was up a lot since the beginning of the year until it recently started pulling back. I mean, we saw double-digit gains until today. The stock taking the exact opposite path of Philip Morris, down 4.52%, which honestly is not a surprise. There's some cyclicality to some of the expenditures that come into Verizon here. And when we take a look at that, because their operating revenue is null, it does not change a whole lot. It hasn't done hardly anything. And the problem is the expenditures have gone up. We're talking about debt payments, so much more. You take a look at selling general administrative costs, probably had some one-off expenses that hit $9.7 billion, up pretty dramatically, 21% over last year, leading expenditures up to $27.4 billion versus 25.8. That's killing the company, right? Like it's really eating into that net income, which is now down 12.5% year over year when you take a look at their 9-month ending, right? So Verizon needs to get out of this gutter. And this is what I keep talking about with what I consider to be interest rate recovery plays. All these kind of really high debted companies that are dealing with expenditures and layoffs and all this stuff, they're kind of stuck in this bottom feeding of trying to recover the earnings. And I feel like we're bottoming out, and I've stated this. I think we've seen the the bottom because earnings have bottomed. So now we just got to get more interest rate cuts. We got to see a slow recovery, get through paying off all these severance packages and all the stuff that they did to try and, you know, clean up the operating margins. So it'll be neat to see kind of where we go from here with Verizon. Now, the third stock that I find the most interesting is General Motors. The dividend sucks. This company, again, like many, didn't do anything for years, and now is up 48%. I mean, you look at the history of this company, and since like 2008, it did nothing. It's been an abysmal place of capital rot. And they have not been investing in the future of EV. They canceled so much of their EV lineup to focus on what the unions, what the shareholders were complaining about, which was bottom line. Because who cares about the future? Why invest in the future, right? Things are stable. Internal combustion cars ain't going anywhere anytime soon. And that bet seems to be paying off. I mean, the revenues are up 10%. Look at their earnings here. Their earnings are up 21%, double digits. This is what's getting investors excited. The question is this short-term gain going to lead to long-term pain? That is a question I'll pass off to you. If you believe in EVs or hybrids or whatever the future is going to be, General Motors, you think it's still going to be around? I'd love to hear about it. But again, look at their earnings. Like, their earnings are just going on a nice recovery spiel here. But let's talk about 3M a little bit. I think this was an everything money favorite. Some of the other investors out there on YouTube, the finfluencer clowns like myself, this stock jumped up 72% from its lows this year, 2.11% dividend. The high yielding dividend's long gone, and the stock as well is pulling back on what seems to be pretty robust earnings. I mean, if you read the headlines, 3M shares reversed massive gains, turned negative despite solid earnings report. 3M produces a lot of boring products, including earplugs that didn't work so well. I think that were sold to the Army or something, that basically led them to getting sued for multiple things that really led to like a slowdown in certain products, and it was just been a mess. During COVID, this thing was a gem for masks and everyone was getting excited, but now it's become the complete opposite. It's been a devastating story, but now a turnaround story nonetheless. We have maybe found a bottom here, and if we take a look, I'm not sure why the stock maybe just got overbought. That's why it's selling, but operating income is at a positive 1.3 billion versus a $3 billion loss this time last year, right? So the company is turning it around. There's some hope here, and it's gonna be neat to see what it does, but maybe you just got a little too excited. Only down 1% on earnings, probably gonna recover, right? So let's get into the geopolitical event. In a world that is seemingly unstable, here we have a really stable, incredible growth beast. I mean, it's up 700%. Since basically 2010-ish era. I mean, it's not paying the yield that it was. Anytime Lockheed paid over 3%, it was a pretty good buying opportunity. And on its recent earnings, the stock dropped 6.3%, which is quite painful after a 30% run up this year. But if we take a look at what might be causing that, honestly, they've had some delays in certain product shipments. And I'm curious also about the innovative future of Lockheed. They make high-valued, high-margin jets and things of that nature for use in these geopolitical events. And unfortunately, drones and cheap warfare are the things that are becoming the spotlighted future of warfare, I think. And, their net sales are still up very nicely here on a year-over-year quarter. 9-month ending are up very nicely. They do a variety of different products as well, missiles. They make all kinds of war-related products. Net earnings, they had some higher expenditures, so net earnings were down slightly. But if you take a look at net earnings, they've been flat for the most part. And again, they had that massive bump up, and their revenue, again, seems to be sitting in a very healthy spot right now. So this is what's led to this really great kind of outperformance this year. And it's going to be neat to see where Lockheed goes in the future. It's just been one of those stocks that everyone said you should buy for defensive play, and it seems to be proving true as these companies start to approach a couple $100 billion market caps. It's incredible that warfare-related stocks, tobacco-related stocks are really working their way up the S&P 500. I mean, we're talking about anywhere from top 20 to top 50 stocks now in the S&P 5. These companies are becoming real movers. They're making a big difference, which is what's leading to this kind of outsized performance outside of tech in the lower half of the S&P. This is why the markets can still remain strong into the end of the year. This is why you should, when we get these kind of dip periods, keep looking at cost averaging. Even though I'm stacking cash, many people are stacking cash, keep cost averaging, folks, because again, if we're still in this strong market that we're seeing in the earnings we're seeing right now, again, maybe we're slightly overbought, could see a correctional period, but that correctional period will just be a buying opportunity. But time will tell. Earnings have been strong, could be a soft landing, but I'd love to know what you think in that comment section below.